Good good morning. It is March all day.
Huh?
This is the morning blast. Taking one look at the markets. Are you not entertained with what's going on? If you think this is boring, you need to get a life. This is the most exciting time in the world ever until the next crisis. As usual, myself and Michael Brown will be dissecting what's been going on, a little bit of a recap of yesterday, a little bit of view on what to look forward to, and a little bit of a chatter about markets in general. Nothing discussed on the podcast is trading or investment advice. We don't edit these. If you're not listening to them live, don't worry, you're not missing anything else, because we just haven't got the technical know how to edit them, so you get them as you find them, and which normally includes a lot of swearing and stuff like that. So there you go. Michael, are you entertained?
Oh, I'll tell you what, I'm absolutely fucking knackered is what I am. And running across the office to go and get my notes for this did not just help. But
You have
there
notes?
we go. I know, it's shocking, isn't it? But I do. God, I'm slightly out of puff now. But yeah, what a day yesterday proved to be. We sort of started off this time yesterday talking about Armageddon and the world's going to come to an end and energy prices are going to induce hyperinflation, stagflation, fuck knows whatever else. And we ended the day with, all was kind of fine and dandy in the world once more, and we're right as rain again. So, where do we stand?
Well, this is it, right? I think, as I just posted on the old Twitter, I refuse to call it X. But, all markets care about right now, in order, are tweets from President Trump, fundamentals, and then technicals.
Which is just as well that Clive hasn't bothered to write us a roundup this morning.
Yes, quite. We're dearly missed as always, but yeah. But no, it's, where do we start with yesterday? I think, it was one for the, however cynical you are and whatnot, and you can say that this is what fast markets do. I did put out a note to some people yesterday about fast markets, and obviously we covered it in yesterday's show about how you've got to try and, for many people, staying out of the market is the best thing to do in these situations. Which I've already heard some stories of actually professional oil funds going bust, which is never good.
Yeah, I was actually, I'm hoping my mic was off, but I was actually just talking about a similar thing on the desk before I came onto the podcast this morning. And, even when institutions are struggling like that, people who've got decades of experience, it's going to be almost impossible in the retail world without a huge dollop of luck to make any decent P&L out of the market. And you don't want to leave your trading strategy to luck at the end of the day.
Exactly. This is why I know a number of people kind of, as soon as this started really getting a bit silly, pulled out of trading the front month altogether. Because obviously that is the most volatile. But do you want to give a quick recap?
Well,
things that happened this morning, and have a little bit of a deeper dive in the rant, or
I will do. I mean, I think just in terms of price action, you've got to be living under a rock not to know what's going on. I reckon you've been doing this double the length of time I have, Ryan, without wanting to make you feel old, but in the decade I've been doing this, it's certainly one of the most memorable days in terms of monitoring, participating in financial markets.
I'll tell you what, it's another day where the crude chart has been broken, because we had it
forever.
We had it when we had it when front month went negative. Actual crude didn't really go negative. That's another conversation for another time over a beer. But also, because I can't say too much on here, as you know very well.
Move on.
But it was broken one way and that was broken another way.
Exactly.
It's going to really fuck up a lot of people that backtest.
I tell you what, those Elliott Wave people are going to be in an absolute shambles, aren't they? Is it A5, 2, whatever the fuck they look at? Anyway, we might as well start there, because obviously crude benchmarks did gap 25, 30% higher at the open on Sunday. We had Brent and WTI. Well, Brent traded up to $125 a barrel. WTI traded as high as $120 a barrel. We settled up by about 5% apiece on both, but then we actually slipped about a further 10% post-settlement yesterday, with WTI actually very briefly breaking below $90 a barrel and trading below that $90 a barrel handle this morning. Currently, both Brent and WTI trading down by about 7% on the day. I've got to say it, that does technically mean that they're both in a bear market, because they're 20% off their high.
Right, so on this, I saw that you tagged me yesterday. So obviously, We all know that me and Michael have a few little bugbears, and we make sure we make everyone aware.
Can I just stress before you go on with this one? I am fucking around. I'm not seriously suggesting that.
No, exactly. Exactly. The one thing that me and Michael do agree on, obviously, we disagree with things like ADP and ADM. ADP and NFP. But one thing we do agree on is that we both believe that this categorization of a bear market or bull market being 20% off the lows or 20% off the highs is bollocks, because in volatile times and in volatile markets, it does all fall apart. And this is a key point. This is why we always look to the 200-day moving average. And even then, it's not like a binary switch that, on off and you go, bosh, right, this is now a bear market, this is now a bull market. But if a market is trading above the 200-day, I'm likely to say, this is bull market territory, or if it's below, it's bear market territory. Or if it's going sideways, if it's just fleeting between above and below for a significant amount of time, it's just going sideways.
Do you know what? In many ways, it's a bit like, from a trading perspective, it's a bit like recessions. And please do not clip this and quote me, but recessions don't matter if you're trading, because by the time the NBER or whoever it is determine that we're actually in a recession, we're probably towards the end of it, if not out of it already. The fact that we're in a bull market or a bear market or a consolidation phase or whatever the hell you want to call it should not really change your approach to financial markets much, if at all, I would argue, from a pure speculative perspective.
Absolutely. And in fact, I've put out a number of times a tweet that basically says that, really, like, proper traders, should we say, kind of like, people that I know that are very successful traders, etc., they don't give a shit about the day that a recession is labeled, because the market's been going one way or the other way for a particular amount of time anyway. It's not like markets all of a sudden get worse when the recession label lands. No. As you say, it's so it's looking back at least 2 quarters. Therefore, you're already in the shit if it is labelled. Yeah, it's It's a number of things that basically economists and book smart people, which I certainly am not. Economists and journalists seem to love these bear market indicators and these recession labels a lot more than the actual traders on the coalface.
It's good for a headline, not good for actionable trade ideas. Anyway, now we've set the world to rights in terms of bull and bear markets. That sort of reversal in crude really just set the tone for what we saw elsewhere. It's very much still a market where correlations are tight, if not still one, with what we see in crude. So stocks were obviously lower to start the day. The S&P and Nasdaq down about 2%. Both of those ended higher by, as near as makes no difference, 1%. Treasuries, a big chunk softer early doors, actually ended the day pretty much unchanged across the curve. The dollar ending the day flat, with the dollar index well off the highs, just shy of the 100 figure that we printed intraday. Before we get onto why markets did what they did, and in terms of the catalyst that participants were digesting in particular, I think the price action, if you just zoom out in terms of what we saw yesterday, it speaks back to something that I think I've mentioned on this recording previously, also that our very good friend Helen Thomas has been talking about since the back end of last year, which is this idea that market participants do not want to get caught short. Now, no sniggering at the back when I say that. What I mean by that is, yes, there is a lot of risk, and a lot of this risk comes from political actors, primarily President Trump in the United States. But what I think most participants would have learned on the back of things like Liberation Day last year is that the entire market and macro outlook can turn around on the back of a tweet or a Truth Social post or a throwaway comment to a reporter somewhere. And as everyone knows, that there is always the chance, if not the relatively high likelihood, that what we perceive as irrational actions may suddenly be substituted for a more rational approach from the political leadership of the world. And as and when that happens, it's going to be a pretty brutal rush for the exit from those short risk positions. So no one wants to be the last bear to change their mind, which creates this really weird dynamic. And I think it actually helps to explain why stocks have been relatively resilient despite what we see. You've got this weird dynamic where, on the one hand, your head is almost going, you know what, this is quite bad news. I should be a little bit more defensive. I should trim down my risk levels. But on the other hand, you're kind of going, do you know what? Actually, I can't do that too much, because I don't want to go outright short, in terms of equities, because just in case this does all flip on its head, I'm going to be on the wrong side of a 10% face-ripping rally.
Yeah, I think this is where the smartest people in the room, or people that actually are taking into this all into consideration, are actually using options and stuff like that to put on their position. Because you can.
Although if you are, sorry to interrupt, if you are trading options, you do need to be very careful with how high implieds are trading at this point.
Oh yeah, of course, yeah, because it could be the best trade in the world, but if IVs fucking too high,
again, not trading advice, but if you're a retail trader who's never traded a fast market, do not fucking trade it through options as your first attempt. Please, right?
We do say, and we kind of joked about this yesterday, we always say that nothing on this show is trading or investment advice, but the only investment advice we do give is stay out of markets when you don't know what's going on, or when you're just a bit out of your depth, because I promise you, capital preservation is 99% of trading.
Yeah. I mean, if you don't know what you're doing with options, and I don't profess to be a genius on that front, but you can be, there is a scenario in which you can be directionally correct and still lose money based on the other variables that go into that pricing. And if you don't understand the Greeks, then you are proverbially fucked.
Yes, that isn't Greek. That's part of French.
Sort of South London talk coming out there.
You can't. There you go. But the thing is, even when we're talking about trading, we spoke about yesterday about trading smaller size with bigger stops and stuff. But stop losses in an oil market that's ranging $38 in a day. Stop losses are just your stop orders are just decorations, basically. They get picked off the tree. It was a I'm glad I did send out the fast market article that I put together. I'm glad I did send that out to quite a few people, because it was quite quintessentially a fast market problem yesterday. Stops and trying to protect you from being wrong, they're all getting triggered all over the show. Also, again, we need to remember where things stand. The G7 did not release reserves yesterday. We also had, in terms of actual fundamental news, we had nothing really that was bearish. We had, the Saudis saying they're going to be cutting more production. We had we've got the Saudis now going to be going through to the Red Sea pipeline. I think getting up to Javier Blas said this morning maybe up to 7 million barrels a day, which is going to be critical for kind of some off ramp for crude supply. But there was nothing really bearish coming out. The only thing that was bearish, perhaps in terms of the fundamentals, forget Trump's tweets for a second, was the fact that ships have been getting through the strait, and we've seen that now with them just turning off their trackers, then turning them back on when they're miles out the other side. And also, again, I've not seen any news overnight, but we've gone like 24 hours or whatever it is, or 48 hours without Iran, firing anything, stupidly large at anything stupidly critical. And then, but most importantly, and anyone that is I don't think we've actually covered it. Anyone that isn't aware of exactly what the tweet that moved the oil market was yesterday, it was basically Trump told I think it was a CBS reporter, that the war is pretty much complete.
Well, I was actually just going to come on to that, because I've taken this from Andrew Hart, very useful morning note, so thank you for letting me steal that one. It was, and I agree with you, it sounds weird to say it on a day when, crude traded in a $40 a barrel range, and, the S&P traded a 3% range from high to low and all the rest of it. But there wasn't really anything kind of fresh fundamental in terms of new developments. As you said, the G7 have kind of punted that decision on an SPR release to the energy ministers, who are due to meet today. Whether they decide on that or punt it to their leaders, remains to be seen. That's at about 1:15 London time this afternoon, that energy meeting, by the way. But those Trump comments were interesting, because as Harty said in his note, that there's almost something for everyone in them, because we had Trump speaking on the phone to this CBS reporter, where he was saying that the war is pretty much complete and it could end soon. And then Trump later in the day was giving a press conference at some sort of House Republicans retreat, and he said a number of things. The first thing he said at this retreat was, again, reiterating, I think the war is pretty much complete. The war will end, and I quote here, very soon, but not this week. And then, on the other hand, he turned around almost 30 seconds later and said, we won't relent, and again I'm quoting here, we won't relent until the enemy is totally and decisively defeated. And overnight on Truth Social, he was threatening to hit Iran 20 times harder if they do anything that stops the flow of oil within the Strait of Hormuz. So I think, again, it comes back to what I was saying a moment ago, where, market participants are almost just desperate for any good news. That we've always been conditioned to expect that at some point with things like this, there is a U-turn. There is, if you want to call it a taco moment, you can call it that. And it's almost a case of people trying to front run what they see as that inevitable off ramp that the administration will take at some point. Going back to what I just said, where you don't want to be the last bear to change your mind when the market is 5, 6, 7% offside.
Well, yeah, I think blinking you miss it is 5% offside, but yeah.
Well, yeah, exactly.
No, exactly that. I think, and the thing is, unfortunately, well, it depends who you are. Fortunately, unfortunately, things aren't going to change for the foreseeable. I think we're going to have some, we're going to have some very big ranges in crude. Famous last words, but in my opinion,
I'm going to go and sell some vol when I get back to the desk.
But I think we're going to continue because this is what we tend to see. Now the market has kind of, think of it as like an elastic band, right? Now the market has stretched that band. There's a lot of like room within that kind of band now where we can move around without it pushing any like limits, like psychological limits and whatnot. So it normally takes a while for the market now to kind of correct itself and just kind of come back into kind of normality. Personally, this is the kind of thing for me that normally takes a week or two. But again, we're still technically at war, I guess. So I'm very grateful that I no longer trade crude. Don't get me wrong, I've had some nibbles.
Your brokers aren't.
Well, exactly. I have had some nibbles and I'm up, so I'm quite happy to now just sit on my hands now. I'm not gone. I know, it's taken me nearly 30, best part of 30 years to work this out, but I now understand when to cut, take my chips off the table, which for a long period of time I didn't.
And I think the other thing, actually, we've both said there was a lack of kind of fundamental developments yesterday. And I think this is really important because Trump is, to give him a bit of credit, when he wants to, he is actually very good at, calming down financial markets. And Treasury Secretary Scott Bessent is pretty good at the same thing. Don't get me wrong. They can rile the market up when they want to, and they certainly have done. But they are also very good at jawboning volatility lower and manipulating assets in the direction they want them to go. The problem is, this is not a case of we're only worried about the equity market where you can inject a little bit of hope and optimism and a few dreams and everything's going to be all right again. This is a physical crude market where, no matter what President Trump, Scott Bessent, Energy Secretary Wright, whoever, no matter what they say to journalists and no matter what they say on Twitter or social media, the nub of the matter is still that the Strait of Hormuz is essentially impassable, apart from a few random Greek ship owners who want to kind of run the gauntlet. And that means that a significant number of barrels are offline in terms of global supply. And, yes, the market in terms of crude futures has been becalmed, so to speak, over the last 24 hours or so. But I think it is
12 hours.
Well, yeah, that's true, actually. Yeah, 12 hours. And again, I'm not an expert on the physical crude market, but conditions are still going to be very tight and they're going to tighten further because all of the issues we were talking about yesterday and last week in terms of storage filling up, in terms of barrels not being able to get out, in terms of production potentially having to be slowed in order to prevent it being turned off entirely, et cetera, et cetera, et cetera. All of that is still the case. President Trump saying the war will end very soon does not magic up 10 crude tankers to sit off the coast of Kuwait and act as floating storage at the end of the day.
But then counterpoint, this is why it's so intriguing, but then counterpoint, you look at the oil curve, which is, look away from the front month, which is just full of speculation. Look at the oil curve, it's still telling us that this is temporary. The front month is trading at a massive premium to the back end of the curve, and the back end was also pricing in normality before the war started. So for me, I would always look at where the curve is trading because that's where more of the smart money is. And also it's where, a lot of the bigger desks are now moving. Funny enough, just whilst been on, I've seen that Balzani, or however you pronounce it, Millennium and Point 72 have actually apparently done their absolute conkers in this move. So it'll be interesting to see some figures when we get them in the next, coming weeks, I guess. But yeah, as of all these things, it really does not pay to be a hero if you don't know what you're doing. But yeah, what else have we got to look forward to today, my friend?
Another day of sitting there watching crude benchmarks trade in a horrifically wide range. Is that what we've got to look forward to? There are actually just a couple of other bits I did want to just very briefly cover over in terms of yesterday, because again, Wasn't all geopolitically related. We did have a few bits of news on the trade front. The SCMP saying that this Trump-Xi summit at the end of the month, start of April, that's going to be confined to Beijing. There had been some reports that Trump might go on a bit of a tour of China, but that's not happening now. The other development on the tariff front yesterday was that the New York Post reported that the various small businesses in the United States have put in place a lawsuit and are suing the Trump administration regarding the new 10% global tariff. If that sounds familiar, it's because it is, because this is exactly the same people who sued against the IEEPA tariffs. I don't think, again, putting my amateur lawyer hat on, I don't think this one's going to be quite as impactful, though, because, of course, the tariffs are due to expire after 150 days. And if we've learned anything about the US legal system, it's that it ain't very quick. So that one is probably not going to get heard until well, after the tariffs expire. The other thing is that the BOE are getting rid of 10% of their headcount. 446 staff are set to leave in the coming months. And somehow, Chief Economist Hugh Pill, despite being wrong about everything for the last 5 years, he's not one of those who's losing his job, which is a bit of a shame.
Yes, quite indeed.
Do you want the day ahead?
Yeah, what else?
Not a lot. Geopolitical headlines are going to dominate, naturally. Kind of goes without saying at this point. The only notable data release is at 2:00 this afternoon, the existing home sales stats out of the States. That doesn't matter, let's be honest. I haven't even written down the forecast. The other bits and bobs that we've got to focus on, a few ECB speakers. They are into their pre-meeting blackout period at this point, so probably nothing on policy there. The US is going to sell 3-year notes at 5:00 this afternoon, London time, $58 billion worth being sold. The rally that we've seen in treasuries will probably help that get taken down relatively well. And after close, we've got earnings from Oracle. Yes, we're all focused on geopolitics. We're all focused on the Middle East. But worries about AI have not gone away. And Oracle is obviously I've forgotten the bloody word again.
Bollocks.
What is Oracle? They are the
data centers.
No, there's a word for it that I now can't. It's on the tip of the tongue.
IT company.
No, they're not that. They're basically totemic when it comes to the whole worries around.
They're what?
Totemic.
What the fuck does that mean?
You can go and Google that. When it comes to concerns around debt financing and over-reliance on one customer, etc. So their shares have halved since September coming into the report, so it could get a little bit ugly. Options pricing an 11% move in Oracle stock after hours, so be very careful if you've got any exposures there. But of course, geopolitical events very much going to be front and centre throughout the day once more.
Wonderful. Well, like we said at the start of the show, if you are trading, keep it tight, be careful. Hope we've added a bit of value today. Hopefully we put a smile on your face. I've certainly learned at least one new word. Thank you for that. What was it again? Say it again.
Totemic. Totemic.
Is it anything to do with like a totem pole?
I think that's actually where it comes from.
Oh, yeah, he's back.
Well done, Ryan.
Thank you, mate. I felt that virtual tap on the head. Thank you. On that bombshell. Listeners, whatever you're doing, honestly, please stay out of trouble. We do value you listening, so yeah, try and stay in the market.